So again, you're talking about from the credit union's perspective, they're advancing this pile of money on the front end that's going to be used to pay the premiums. Maybe it's like a 10-pay policy or something over time for the executive's life insurance policy. And the credit union now has a note that guarantees that the principal repayment plus a modest 0 to 2% return, which, as you're saying, in the 2013, that wasn't such a bad deal. Now that rate of return isn't very attractive. But on top of that, they don't even know exactly when they're getting paid back, because they get paid back when the death occurs on the insured.
Yeah.
And then out of the death benefit check that the carrier sends, the credit union gets paid back plus interest. And so it's a double whammy of a modest return and an uncertain date of redemption.
Absolutely. Yeah, there's over $1 billion worth of split dollar loans on the balance sheets at credit unions that are on people who are no longer employed at the credit union. We tell people out there, this is a pretty large marketplace. There's over $9 billion of these split dollar loans out there, right? So it's a lot of capital that's out there. And we don't know when they're going to get paid back. And so that does create a major pain point. Not to mention, what I was saying a second ago is a lot of this capital is out there and it's not even actively retaining somebody in this very moment. That person's either retired or they left to go to another opportunity. So that's probably the biggest downside of these tools is the opportunity cost, the lack of clarity around duration, and the impact on the balance sheet to the credit union.